Imagine discovering an investment that has doubled in value every year for the past 3 years. Your neighbors are buying it. Your coworkers can't stop talking about it. Television experts insist this is only the beginning. Someone you know made more money in 6 months than they earned during the previous 10 years. You know it sounds too good to be true, but you also know one terrifying thought. What if everyone else gets rich, and you don't? That single question has destroyed more fortunes than almost any market crash. Because every financial bubble in history begins the same way. Not with greed, with envy. And that changes everything. History loves to remember bubbles as economic disasters. The tulip mania, the South Sea bubble, the dot-com boom, the housing crisis, cryptocurrency frenzies. Each feels like a completely different story. Different countries, different centuries, different technologies, different investors. Yet if you stripped away the names and the headlines, you would discover something remarkable. The asset changes, the psychology never does. To understand why, we have to travel nearly 400 years into the past. The Netherlands in the 1630s was one of the richest societies on earth. Trade flourished, merchants accumulated fortunes, cities expanded, optimism filled the air. Then something unusual happened. Tulips became fashionable. At first, they were simply beautiful flowers imported from the Ottoman Empire. Rare varieties became symbols of prestige. Prices climbed. Collectors rushed to buy them. Then traders realized something. The flowers could be resold for even higher prices. Suddenly, people weren't buying tulips because they loved flowers. They were buying them because someone else would probably pay more tomorrow. Within months, some rare bulbs sold for prices comparable to elegant homes. Ordinary workers borrowed money to speculate. Families risked their savings. People traded contracts for flowers that hadn't even bloomed yet. Then, something unexpected happened. One auction attracted almost no buyers. Confidence cracked. Prices began falling. Then, they collapsed. Almost overnight, fortunes vanished. Looking back, the madness seems impossible. Who would pay the price of a house for a flower? But here's what nobody tells you. People weren't buying tulips. They were buying a story. A story that prices could only go higher. Centuries later, the flowers disappeared. The story returned. Only this time, it wore a different disguise. The late 1990s introduced the internet to millions of people. It truly was revolutionary. Entire industries were changing. New companies appeared every week. Investors correctly believed the internet would reshape the future. Their mistake wasn't believing in technology. Their mistake was believing every company connected to that technology would become valuable. Businesses with almost no revenue achieved billion-dollar valuations. Some had never earned a profit. Others barely had functioning products. It didn't matter. Stock prices kept climbing. The phrase, "this time is different," echoed across financial television. It always does. When the dot-com bubble burst in 2000, trillions of dollars disappeared. Many companies vanished forever. Yet the internet itself changed the world exactly as people predicted. The technology wasn't the illusion. The prices were. This is where everything changes. Financial bubbles are rarely created by stupidity. They're created by truth mixed with exaggeration. There's usually a genuine innovation. Railroads, automobiles, the internet, artificial intelligence. Real breakthroughs. But human psychology quietly transforms reasonable optimism into irrational certainty. Behavioral economists call one of these forces herd behavior. When uncertainty is high, humans naturally copy each other. Our ancestors survived because following the group often meant avoiding danger. If everyone in your tribe ran away, asking questions first could be fatal. Today, that same instinct appears inside financial markets. If everyone is buying, perhaps they know something. The more people buy, the safer buying feels. Ironically, popularity becomes evidence, not because anything fundamental has changed, but because everyone else believes it has. Then dopamine enters the story. Neuroscientists have found that uncertain rewards activate the brain's reward system more powerfully than predictable ones. That's one reason gambling becomes addictive. You never know exactly when the next win will arrive. Markets often produce the same emotional cycle. A successful investment creates excitement. Another successful trade reinforces confidence. Soon, checking stock prices becomes a daily ritual. Not because investors need information, because their brains begin craving anticipation. The market stops feeling like investing. It starts feeling like entertainment. However, another psychological trap quietly appears: fear of missing out, or FOMO. Perhaps no emotional force has fueled more bubbles. Imagine watching your friends double their money while your savings account earns almost nothing. Every conversation reminds you of opportunities you've missed. Every headline celebrates new millionaires. Every social media post feels like proof that everyone is succeeding except you. Remaining patient suddenly feels irresponsible. Joining the crowd feels rational. This is exactly what happened during America's housing boom in the early 2000s. Home prices had risen for years. People stopped asking whether homes were affordable. They only asked how much prices would rise next year. Banks approved increasingly risky mortgages. Television shows celebrated house flipping. Ordinary families purchased multiple investment properties. The assumption seemed obvious. Real estate always goes up. Then something unexpected happened. It didn't. When prices reversed, the consequences reached far beyond homeowners. Banks failed. Businesses collapsed. Entire retirement accounts were devastated. The financial crisis of 2008 became one of the worst economic disasters since the Great Depression. Yet even then, the psychology remained unchanged. Confidence became panic. Greed became fear. The crowd simply changed direction. Behavioral economist Robert Shiller, who spent decades studying speculative markets, argued that bubbles spread much like contagious stories. People don't buy because of spreadsheets. They buy because of narratives. The narrative spreads from neighbor to neighbor, investor to investor, television to smartphone. Storytelling moves markets long before mathematics does. The surprising part is that intelligence offers surprisingly little protection. Doctors invested, lawyers invested, economists invested, professional fund managers invested. History repeatedly shows that bubbles don't trap only the uninformed, they trap humans. Because intelligence doesn't eliminate emotion, sometimes it simply creates better justifications for emotional decisions. Legendary investor Howard Marks once wrote that the biggest investing errors rarely come from missing information, they come from psychological mistakes. Confidence, impatience, optimism, fear. These emotions influence billion-dollar decisions just as easily as everyday purchases. Perhaps the most dangerous phrase in every bubble is also the simplest. This time is different. Every generation believes new technology has rewritten financial history. Sometimes the technology truly is revolutionary. The internet changed civilization. Artificial intelligence may do the same. Electric vehicles transformed an industry. But innovation and investment returns are not identical. A great invention can still become a terrible investment if everyone pays too much for it. That's a distinction our brains naturally struggle to make, because humans don't just evaluate facts, we evaluate each other. The market is one of the few places where seeing everyone run towards something actually increases our desire to follow them. Yet history repeatedly rewards those willing to ask an uncomfortable question. What if the crowd is wrong? Not because the crowd is always mistaken, but because prices eventually stop reflecting excitement and begin reflecting reality. Perhaps the greatest lesson from every financial bubble isn't about stocks, houses, cryptocurrencies, or tulips. It's about ourselves. Technology evolves, economies grow, markets become faster, algorithms become smarter. Yet the human brain remains remarkably familiar. It still craves belonging. It still fears exclusion. It still mistakes popularity for proof. It still believes extraordinary opportunities will last forever. Every bubble eventually bursts, not because humans stop dreaming, but because reality eventually catches up with emotion. And perhaps that's why the most successful investors throughout history rarely try to predict the next bubble. They spend far more time trying to understand the person most likely to be fooled by it. themselves.